A system designed to be stable for decades doesn't implode randomly. It fails the way a star collapses silently at first, then violently all at once. And right now, a foundational pillar of global finance is cracking in real time. Most people don't see it. They're busy reacting to surface-level symptoms. A tech stock plunges, crypto convulses, a bond auction fails. But these are just pressure waves. The real event is deeper. A $200 trillion engine built over 30 years is stalling. And when an engine that big seizes, the entire machine shakes. If you've ever wondered what a slow-motion global margin call looks like, this is it. For decades, the world has relied on a strange anomaly, a major advanced economy keeping interest rates frozen near zero. Regardless of global cycles, recessions, booms, collapses, or geopolitical storms, that anomaly is Japan. And Japan's zero-rate policy didn't just affect Japan. It became the invisible power source of global liquidity, the quiet pump pushing cheap capital into every corner of the financial system. Artificially low rates survive only in a world where nothing disturbs them, but now they've collided with reality. Inflation, politics, deficits, demographics, and the limits of monetary engineering. The effect is simple. The cheapest money on earth is no longer cheap, and when the cheapest money becomes expensive, everything priced under the assumption of endless cheap leverage gets re-rated. That includes stocks, bonds, crypto, housing, private credit, artificial intelligence, infrastructure, and entire governments. To understand the magnitude of this shift, we have to go back to the roots, specifically to a strategic arbitrage mechanism engineered by hedge funds, sovereign wealth funds, pension systems, and institutions across the world. It's called the yen carry trade. It sounds esoteric, but its consequences touch almost every retirement account on the planet. Here's the basic idea stripped down to first principles. Borrow in the currency with the lowest interest rate, convert it into a currency with a higher interest rate, buy assets that yield more than your borrowing cost. Pocket the spread, repeat, scale, leverage, automate. Eventually, it becomes so large and embedded that it transforms into a background constant of the global economy like gravity. For Japan, 0% rates were a defensive measure after the collapse of their asset bubble in the 1090 seconds. But globally, those same 0% rates became an opportunity too good for investors to ignore. At times, the gap between Japanese borrowing costs and U.S. yields exceeded 4, 5, even 6 percentage points. In financial terms, that's a gravitational anomaly, a warp in the cost of capital. And when the universe gives you a warp, you exploit it. So trillions of yen were borrowed at near zero cost. That yen was sold. Dollars, euros, pesos, and everything else were bought. Assets were accumulated. The trade expanded until it wasn't a trade anymore. It was infrastructure. It powered stock buybacks, private equity deals, sovereign bond purchases, and the valuation of entire sectors. You can draw a straight line from the yen carry trade to the rise of Silicon Valley mega-cap valuations. You can draw another straight line to suppressed U.S. Treasury yields, another to cheap mortgages, another to the artificial intelligence boom. These waves of borrowed yen created an illusion of stability. Liquidity seemed infinite. Volatility seemed optional. Downtown seemed temporary. And every dip felt like a buying opportunity. Not because fundamentals were always strong, but because the plumbing was artificially pressurized. That pressure is now collapsing. Japan is raising rates after 30 years. Their inflation is rising faster than expected. Their government bond yields are exploding higher. Their political system is facing a debt burden so massive that even small rate hikes threaten the Solveni math. Investors who relied on the stability of Japanese policy are suddenly realizing the floor is shifting beneath them. A whole generation built investment strategies on the assumption that Japanese rates would remain frozen forever. That assumption is gone. And when assumptions die, trades unwind. Unwinding a $200 trillion trade isn't like unwinding a hedge. It behaves more like a chain reaction. Borrowers need to repay the yen loans they took out years ago. To repay yen, they need yen. To get yen, they must sell dollars. To get dollars, they must liquidate U.S. assets, treasury bonds, tech stocks, risk assets, crypto. This creates selling pressure. Selling pressure drives prices down. Falling prices trigger stop losses, margin calls, forced liquidations, more selling, more dollar weakness, more yen strength. And as the yen strengthens, every outstanding yen loan becomes more expensive to repay, which forces even more selling. This is the mechanics of a global squeeze. We've seen early flashes, Nvidia losing nearly $500 billion in market value intraday, Bitcoin dropping to $81,000, Ethereum following, the Nasdaq swinging by 4% within hours. These moves weren't random. They were signals like the first tremors before a major earthquake. When liquidity vanishes, correlations converge toward one. Everything falls together. That's the opposite of how modern portfolios were built. The financial system has spent 15 years being conditioned to believe the Federal Reserve will save it. But this time, the Federal Reserve isn't the issue. The liquidity drain is coming from outside U.S. jurisdiction. America cannot print yen. America cannot stop Japanese pension funds from liquidating treasuries. America cannot dictate Japan's inflation path, bond yields, political shifts, or demographic pressures. This time, the world's largest creditor nation is pulling capital back home. That reverses a 30-year pattern. One of the most underappreciated facts in global finance is this. Japan has been the single biggest foreign buyer of U.S. treasuries. Now they're selling, not because they want to, because they must. Japanese pension funds are withdrawing over $1 trillion from U.S. government bonds. That's not speculation. That's capital flight from U.S. debt executed by the most stable buyers the Treasury market has ever had. Their currency hedging costs have become too high. Their domestic yields are rising, and their political environment is pushing them to prioritize national solvency. If the biggest buyer of U.S. debt becomes a seller, yields rise. When yields rise, the cost of capital rises. When the cost of capital rises, valuations fall. When valuations fall, collateral weakens. When collateral weakens, lenders pull back. When lenders pull back, liquidity disappears. When liquidity disappears, people sell everything they can, not everything they want. This is the ecosystem people forget. Markets don't move because of news. Markets move because liquidity moves. Right now, liquidity is evaporating. And this process doesn't happen in isolation. It compounds existing fractures in the U.S. system. The private credit markets are in chaos. Lenders are freezing credit lines with almost zero warning. Companies that relied on cheap financing are collapsing overnight because the pipelines feeding them have been shut off. Zombie firms, those barely surviving on borrowed time, are hitting the wall. Fat Brands has nearly no cash relative to its debt. Renova Homes went from full valuation to zero virtually overnight. When companies that appeared solvent last quarter suddenly implode, it means the buffer between stability and collapse has eroded to almost nothing. The tech sector, which benefited enormously from ultra-cheap capital, is now confronting a different problem. Capital discipline. Investors are beginning to question the sustainability of margins, inventory levels, and revenue recognition models at companies that were treated as invincible. Heavy insider selling like SoftBank dumping its $5.8 billion Nvidia stake, or Nvidia CEO selling at the exact local top signals a shift in sentiment. Insiders exit before a structural liquidity event, not after. And that brings us to the depot first principles issue, depreciation. Artificial intelligence chips are being treated as long-term assets, not rapidly depreciating equipment. They're being capitalized in ways that assume constant demand and stable pricing. But supply is accelerating. Competitors are emerging. Markets are cyclical. Chips are commodities, and commoditized assets behave like commodities. Prices fall when supply exceeds demand. When prices fall, companies must write down their assets. Write-downs destroy earnings. Destroyed earnings destroy valuations. In a liquidity crunch, those valuation collapses happen fast. This is why the smart capital is repositioning. They're not reacting to headlines. They're reacting to math. And while that math is playing out, geopolitical tension is adding fuel. China and Japan are entering a dangerous period of friction. Statements from Japan about defending Taiwan militarily cross the line in Beijing's view. China's retaliatory cancellations of Japanese cultural and economic events may seem symbolic, but symbolism precedes escalation. If China imposes stricter economic penalties, Japan's fiscal deficit widens. That makes its bond yields rise even faster. Rising yields accelerate the yen carry unwind. The unwind accelerates global selling. Global selling accelerates liquidity withdrawal. This is how geopolitics and finance reinforce each other in nonlinear ways. You can't separate markets from nations or currencies from politics or debt from demographics. These systems interact, and the moment interactions become nonlinear, stability becomes illusion. People think crises happen when something breaks, but crises actually happen when everything tightens at once. Japan tightening, the U.S. tightening through rising yields, private credit tightening, tech valuations tightening, crypto liquidity tightening, emerging markets tightening, Europe tightening, China tightening in the shadows. The entire global system is compressing. The old era was defined by expansion of money, of credit, of risk appetites, of valuations. The new era is defined by contraction, and contraction forces truth to the surface. The critical question is no longer how high can assets go. It's what is the real price of capital when the world's largest hidden subsidy disappears? If the answer is higher than the market can bear, then almost every asset class must re-prick, not gradually, systemically. So here's the thought experiment. What happens to a global economy built on 30 years of cheap leverage when the world's cheapest leverage source flips polarity? Would it fundamentally restructure the financial landscape, or is the system resilient enough to absorb a shock that it has never once been tested against? The system we built over the past 3 decades wasn't designed for reversals. It was engineered for expansion, not contraction. Every assumption, every model, every valuation framework depended on one quiet constant. Liquidity would always flow outward, never inward. The yen carry trade wasn't treated as a risk factor. It was treated as a law of nature. And when you treat engineered conditions as natural laws, you stop questioning the architecture holding everything up. This is what makes the current moment so dangerous. The world became addicted to a source of capital that wasn't permanent. It just felt permanent because nobody alive has operated in a financial environment where Japan tightened meaningfully. Rates were always zero, inflation was always subdued, and the yen was always weak. Investors built 30 years of habits around that constraint. That constraint is gone. Once you remove the foundational assumption, the models start lying. Yield curves stop predicting. Correlations stop behaving. Risk premiums stop compensating. Even the idea of safe assets becomes questionable. Because safety isn't about what the asset is, it's about what the global liquidity tide is doing at any given moment. People confuse fundamentals with physics, but markets don't move according to fundamentals. They move according to flows, and right now, flows are reversing. To understand the scale of this reversal, consider the mechanics of capital that has to return home. When a Japanese institution borrowed yen to buy USC treasuries, they effectively borrowed at near zero and earned 25% depending on the period. When they hedged their currency exposure, which is standard, they paid a hedging cost that was small enough to keep the trade profitable. Now those hedging costs have exploded. The differential between US and Japanese short-term rates makes hedging expensive enough to erase the entire profit margin. So these institutions are facing a paradox. If they stay in US bonds, they lose money. If they hedge, they lose more money. If they sell, they strengthen the yen, which worsens the losses for everyone still in the trade. If they delay, the next rate hike in Japan detonates their position anyway. There's no scenario where this resolves gently. In physics, a system under rising pressure will eventually seek equilibrium. In finance, a system built on borrowed money returns to origin when the cost of that money rises. And that return to origin event is what we're witnessing. This repatriation cascade forces liquidation across markets that seem unrelated. Tech stocks fall not because their business has changed, but because the liquidity environment changed. Crypto sells off not because of any flaw in the technology, but because it's the most liquid collateral available when investors need cash instantly. Risk assets get hit first because they're easiest to sell. Safe assets get hit second because they're the biggest positions. Cash gets hoarded because survival becomes more important than returns. But the key dynamic isn't selling, it's forced selling. Forced. Selling doesn't care about price, it cares about obligation. This is where the compounding danger lies. The yen strengthening pushes investors into negative carry. Negative carry pushes liquidations. Liquidations push the yen stronger. Yen strength pushes more investors into deeper negative carry. That loop doesn't stop until enough positions are unwound to break the cycle or until something larger breaks. And there's a deeper question here. What happens when a global financial system built on perpetual leverage meets the first genuine deleveraging shock in 30 years? Most people underestimate how much leverage has seeped into every layer of modern life. Mortgages, corporate bonds, stock options, private equity loans, venture debt, government deficits, even artificial intelligence development is leverage-dependent. Compute capacity requires capital-intensive infrastructure financed largely through cheap debt or inflated equity. When capital costs nothing, systems expand. When capital costs something, systems contract. When capital costs too much, systems fail. So the moment liquidity disappears, fragility is exposed. Take private credit. For years, it was marketed as the safe alternative to banks. Higher yield with lower risk. That phrase should always sound suspicious. Yield comes from risk. If the yield is high, the risk is high even when it's hidden. And hidden risk has a tendency to surface at the worst possible moment. When lenders freeze credit lines, companies that look stable implode instantly because their survival depended on constant access to borrowing. The market is discovering that many firms weren't operating businesses. They were operating dead engines. Once the fuel stops flowing, the engine seizes. The same pattern shows up everywhere. Artificial intelligence hype is built on the assumption that compute demand rises forever, but rising demand doesn't guarantee sustainable valuations if the cost of capital rises faster. Depreciation models become more unforgiving. Inventory becomes more expensive to hold. Expansion becomes harder to finance. Cash flow becomes king. The companies positioned for long-term dominance are the ones that can self-fund, not the ones relying on capital markets to subsidize their growth. And then there's the geopolitical layer, a variable that investors historically ignore until it's too late. Japan's rising tensions with China are not a side story, they're an accelerant. When a country faces geopolitical pressure, its priority becomes national resilience. Japan cannot afford a fragile currency while confronting potential regional instability. A stronger yen becomes a strategic necessity. That means rates must rise. And if rates rise, the carry trade unwinds faster. If the trade unwinds faster, more capital flows back. More capital flowing back means stronger yen. Stronger yen means even more unwinding. Another loop. And meanwhile, China has its own incentives. They want influence over currency flows in Asia. They want leverage over Japan's economic vulnerability. They want optionality in the event of a Taiwan conflict. They want to demonstrate that any nation supporting Taiwan will pay an economic cost. Every action is strategic. Every cancellation, every restriction, every sanction is part of a calculated effort to apply pressure without triggering open conflict. Markets don't price geopolitics accurately because geopolitics is nonlinear. A single unexpected decision can reroute capital flows worth trillions. Investors price the present nation's plan for decades. That mismatch creates blind spots, and blind spots are where black swans originate. Now consider Europe. For years, European sovereign debt has been stabilized by foreign demand, especially from Japan. That demand compressed spreads between strong economies like Germany and heavily indebted ones like Italy. Compression created the appearance of structural unity. But unity based on foreign liquidity isn't unity, it's subsidy. And when the subsidy ends, you get divergence. If Japan repatriates capital, European yields rise. Rising yields widen spreads. Widened spreads raise borrowing costs. Higher borrowing costs strain budgets. Strained budgets challenge political stability. Political instability increases credit risk. Credit risk raises yields further. Europe could find itself revisiting the same dynamics that almost broke the Eurozone a decade ago, except this time with less ammunition. Emerging markets face an even harsher reality. Many rely on external funding and stable currency dynamics to keep inflation in check and debt service affordable. When global liquidity tightens, emerging markets don't dip, they snap. Their currencies fall, their borrowing costs rise, and their access to capital markets evaporates. The last time the yen carry trade unwound meaningfully, several emerging markets faced severe stress. That was with a smaller trade. This time, the trade is orders of magnitude larger. All of this leads to a fundamental truth most analysts avoid. The world built a financial system that assumes cheap capital is a permanent condition. It never was. Zero interest rates weren't natural. They were engineered. They were a response to crisis, then a habit, then a dependency. Easy money became the default operating system. It shaped behavior, incentives, and expectations. Investors stopped imagining a world where capital had a real cost. Companies stopped building cushions. Governments stopped budgeting responsibly. Consumers stopped saving. The entire global economy drifted into a state of leveraged complacency. The yen carry trade didn't cause that complacency. It enabled it. Now that the enabling factor is reversing, the complacency is being tested. The question isn't, will there be a correction? The question is, how do systems that have never experienced true capital scarcity respond when they can't borrow their way out? Because scarcity forces decisions, hard decisions, decisions politicians avoid, companies delay, and consumers dislike. Scarcity introduces consequence. Easy money removes consequence, and a system used to consequence-free behavior struggles when the bill finally arrives. When you think in first principles, you realize this is not just a financial event, it's a structural recalibration. For over a decade, we've been accelerating into the future with borrowed momentum. Every sector innovated faster than its natural cash flow would allow because credit filled the gap.